Hello there, Maverick traders. It is March 18th. This is the Market Roundup. This is Rob Reinhold. Nice to have you here. Let's jump into the market. In this session, we're going to talk about what happened today. What was some of the news? We're going to take a look at some commodity things because I really like to see risk on or risk off moves, whether or not they're being confirmed. We're going to take a look at that because we did have a down day today and we definitely got a bear rally trigger here to go more short. I just want to make sure that everything backs it up. Today I've got 2 shorts and 1 long for you.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's break down what happened today.
Let's take a look at the market numbers here today. We had another down day on the markets here. So as you can see, Dow was down about 0.2%, S&P and the Russell down 1%. NASDAQ definitely got hit, down 1.7%. Oil was down, gold was up. Okay, one of the things I'd like to take a look at when we are falling is, are we seeing risk-off assets around the world falling as well? And that's when I'm going to spend a little bit of time today to really talk about where we are in the cycle. We did not have any really bad news over the weekend, which is quite a relief because it seems like all we've had is some bad news, more things on tariffs, more things on retaliatory tariffs. Luckily, that has calmed down at least for the moment, but the market sentiment remains negative. So that means, just like in a bull market, on a day when there's no news, you're likely going to go higher. On a day where there's not a lot of news, you're likely going to get a little bit of selling. As far as the economic numbers go, we did get a rise in import prices. Last month, it was plus 0.1, up plus 0.4. That's a jump, quite a big jump. But we also got some stronger numbers with industrial production being strong and also with building permits being strong. The market right now is struggling with 2 realities. Number 1, inflation is ticking up again and doesn't look to be coming down. The tariffs is really the primary thing driving these inflation expectations. On the other hand, remember in 2021 and 2022, well, not 2022 so much, but in 2021 we had really high inflation, but we had a booming market. Why? Because the inflation was because the economy was booming. Now we're getting inflation and now we have an economy that looks to be softening. This is stagflation, and stagflation is not good. So the question is, can the economy hold on enough to weather this rising inflation? Because look, if the economy can keep growing at 2.5%, you know what? 4% inflation is okay. That's still an okay market. But if we stop growing, we go down to like 0% growth with 4 or 5% inflation, that's not a good situation, and stocks definitely are going to be falling lower. Taking a look at the advanced decline line, we had 2 stocks going down for every one, so it was a bearish market, and we now have about 70 stocks under their 50-day moving average. That is moderately bearish. That's not really bearish, where we typically look for a bottom, but it is moderately bearish. Let's take a look at our S&P daily chart. And I've been very clear over the past couple weeks. I expect a pierce down, which we did. We really slammed down through all the support levels. And I said I wanted to see a bounce, failure at this area, and a confirmation. This is exactly what I wanted. This is exactly what I have expected. Now look, the market doesn't always do that. I don't always get these calls right. And I always love to say, if I could write the script, this is what would happen. The market rarely follows my script, but my script was a plunge, a bounce back, and a failure. This has happened. Okay, we have seen this happen. So the big question is, are we going to see the next step, which is a lower low? And again, nobody knows, but the chart patterns and the technical analysis that's been studied says that more times than not, we are going to see a new low on the next move lower. Now, typically I go to a NASDAQ chart, but I actually just want to go to an intraday chart. And I want to show you this intraday chart of the S&P. Now, I've talked a lot about these kind of charts on up days, when the market has a big run in the morning, and then it goes sideways all day, and then it usually has a little breakout at the end. And I talk about these days, what this means is that there's a thick bid. There's buyers out there on the bid. So anytime the market tries to pull back, people are buying. People are buying. And then it goes up, and then it pulls down, and people are buying. So it literally can't fall because there's always a floor of buyers underneath. This is just the exact opposite. Look at this. Anytime there was a little rally during the day, it was met with plenty and plenty of sellers. This is a super bearish pattern. This tells you that there's still stocks being liquidated. So I do think we are going to have continued down movement. If we take a look at the heat map, you can see we definitely got hit in the Fab 7. The Fab 7, they got hit. They're a big red. Everything else actually looks pretty mixed. This is where I don't want to get too bearish yet. We are definitely bearish. We've been bearish. And I've been saying I want to wait for the pierce, the rebound, and the failure to get really bearish. There's a couple things that I'm just a little bit hesitant about to get super bearish. And that is that we're not seeing big risk-off moves in other asset classes. For example, we should have seen a big down move in the bond yields. That did not happen today. Here's the 10-year bond yields, and you can see this was a nothing day. We should have seen a huge spike up in the yen. You know what? We didn't see that. We did not see a spike up in the yen. The yen was actually down for the day. So a lot of the risk-off things just did not participate. I am bearish. I want to be bearish. We've been bearish. But I'm not quite ready to push on the gas yet because we do have a Fed meeting tomorrow. So I'm willing to wait one more candle to go from a -2 to a -3 because we're really close there. And that's where we are right now. We're at a -2 on our market reading. So we are moderately bearish. We're not the most bearish we can get, but we're really close. If we get a red candle tomorrow off that Fed meeting and we do see that 10-year yield fall, and we see the yen and the Swiss franc spike, that's just a confirmation that, hey, risk off, the route is on the table. We're likely to see a new swing low. With that being said, I've got some trades for you in this market environment, and this list of bullishness has not changed from last week. So I actually had 8 symbols from last Tuesday, and I replaced one of the symbols. All of these 8 are making new all-time highs, and they're all ETFs. One of the things I talked about last week is that when the market volatility spikes, you can get out of those individual names and play ETFs, and there are some wonderful looking ETFs right now. This here is the German ETF, the EWG. We've been talking about how well the Chinese market has been going. We've been talking about how great the European markets have been going. Last week, I talked about the VGK, which is all of Europe in an ETF. It's hitting new all-time highs. Here's the German ETF, hitting new all-time highs. Everything looks good here. Gold looks great. European ETFs look great. Chinese ETFs look great. This is where the market is going because they look at the US and say, hey, the US is now losing some prestige around the world and is losing some capital. The capital has to go somewhere. When capital leaves the US, it has to go somewhere. It's finding its way to Europe and also over into Asia. So I like this trade. I think a trade up to 40 on this is good. I like a 39.40 bull call spread out to the April monthly options expiration. That's a trade I would look at. Of course, you could do diagonal spreads. You could do targeted butterflies. There's a lot of bullish spreads you could do here, but that to me is a pretty simple one, the 39.40. On the bear side, there are so many bears to choose from. So many bears, especially because we just got a nice bear rally. We plunged, we rebounded, and now, so most stocks are going to look like that pattern. I wanted to find things that weren't even doing that. So this is Wayfair. I mean, take a look at this stock. This stock is in free fall and it's not having any bounces. Most stocks had a bounce late last week, early this week. This one did not. Look at these 2 candles. Those are really terrible, awful candles on days where the markets actually had a good bounce back. Today, we just broke down to new lows. I like this one. I think this one's going to 25. I'm not going to be that bearish though. I think you could easily do like a 30-28 bear put spread. That's going to give you, you're probably going to pay about 66 cents, which means you have $1.33, $1.34 in reward. So this is going to be a 1-to-2 risk to reward ratio, and it is directional in nature. So I like this one in Wayfair in the consumer sector, which is one of our favorite sectors. This here is Upstart Holdings. We're going to call this tech financial. Same thing here. We did not get a bounce. We did not bounce on this one. This thing is underperforming here. I'm liking that 45 as a target. So you could do like a 45.50 bear put spread. You could do like a 48.45. You could go lower than 45. You could go all the way down to 40. I'm not going to get that aggressively bearish, but you definitely could. Looking at something like a, you could even do a 45.40 out of the money spread. It's going to cost you probably $1, and you got $4 of upside if it does crash. Let's talk about tomorrow. Tomorrow we have a Fed meeting at 2 p.m. Eastern Time. Most of the time there is very little activity before Fed meetings. That's not all the time, but just most of the time. People are waiting for the news to come out. They're not willing to take big bets before that. So I'm calling for a fairly quiet session until 2 p.m. Eastern Time, and then I think we get a 1-to-2% move afterwards. And I do think it's going to be what I call a whipsaw. We get the statement at 2 p.m. and we get the press conference at 2:30. Now, back when I started trading, there were no press conferences. All you got was the statement and you got the movement, and you could make your moves off that movement. Then they went to every other FOMC meeting. You would have just the statement or the statement with a press conference afterwards. Now, every statement has a press conference after. So I'm actually waiting for that 2:30 p.m. press conference, because what typically happens, very, very typical, you get the first move. So let's say it is a move to the downside. I could easily see us then have a nice bounce back, very convincing bounce back. And then they say something in that press conference that sends it down to new lows, or vice versa. If the initial move is up, I think all of a sudden then we plunge, and then in the press conference, we have a move higher. I'm looking to be more active later in the day than early in the day tomorrow. So if I've got any trade setups, I'm going to make them later in the day when I can really see where that candle tomorrow is going to close. If we get a red candle tomorrow with the close on its low, watch out below. I think we have at least Thursday, Friday, and Monday that are going to be consecutive down candles, and we're going to break down to new lows. If we get a green candle tomorrow, I think we're going to be stuck kind of in this range underneath that resistance that we just broke. That is the market roundup. Take care, everyone. Goodbye.